Welcome to the B.F. Anderson Technical Report for January the 6th. I thought this was an interesting graph where we're looking at junk bonds. The default rate has fallen to really a record level. We've never seen default rates this low. Now, the thing that's interesting about junk bonds, right now the yield is around 4%. So you're taking basically an equity risk in order to make 4%. Well, with inflation right now running about 5%, you're actually getting a negative return for taking an equity risk. I have a feeling this will have a lot to do with shifting money from the bond market to the equity market because it's becoming clear that equities are outperforming bonds. So let's just kind of take a look at where we are right now. As you can see here with the NASDAQ, which is really having a tough time right now. In fact, as I speak, it's down about 150. It's pulled back, rallied, pulled back again, rallied, not making new highs. So the real problem here is actually with the technology stocks. They're just starting to underperform, and you should respect that. However, on a long-term basis, we continue to feel that the market continues to be in a bull market, just experiencing basically some rotation here out of technology into other things, which we'll talk more about. Here's the mid-cap index actually doing quite well. Has not made a new high, but like the NASDAQ, has pulled back, not making a new high. On the New York Stock Exchange, New York Composite, where you got a lot of bank stocks, a lot of energy stocks, you can see here making a new high. This is probably one of the more positive indexes we're looking at. Small cap, same thing. We've gotten the pullback, rally, not making a new high, so continue to be cautious. S&P continues to do quite well. The large cap stocks are definitely leading this market. You can see the S&P recently hit a new high. So of the 5 indexes, we're hitting new highs on 2, not hitting new highs on 3. It's just not a broad bull market. Wish it was. However, on the S&P, you can see new high holding above the 35-week, continues to stay in a bull market. Now, on the what's really causing things to get rough right here is that interest rates are starting to rise. And you can see it in the yield curve where I'm comparing the 5-year Treasury to the 3-month Treasury note or bill, 3-month bill, 5-year note. You can see that the spread is actually improving where the longer-term bond is going up faster than the short-term bond. We're at roughly a 1.3 spread, whereas a couple of weeks ago, we were down in this area here. So we're seeing interest rates rise. That is causing a problem for certain stocks. Now, the bank stocks are doing really well here and so forth. So you can see here with interest rates, the old high is up here about 1.7. We're at 1.656, but we did basically get a major move here up this week. Now, you can also see here with oil stocks, we're up to $77 a barrel. It's hard to say what's going to happen here, but the oil stocks, oil prices are definitely an uptrend. Now, as you can see here with the bank stocks, this is the financials breaking out actually to a new high following interest rates. So the banks are benefiting from this. New lows somewhat settling down, however, continue to stay a little elevated. Now, on the sentiment readings, we're starting to get back sort of in greed. We're at 7.2 on the ratios, 7.5 is the average. So we're seeing somewhat of a neutral posture there. On the put-call ratio, we continue to stay somewhat in fear. However, we've had a big move here out of deep greed to somewhat neutral, kind of moving back down again. So sentiment is less than favorable. Now, I did want to show that the percent of stocks above the 200-day moving average on the NASDAQ, you see here we held the 25, but kind of just barely kind of came out of this, not really seeing a lot of conviction there, especially when you compare it to the other indicators. Now, on the junk bond ratio, we're seeing an improvement there. Like I mentioned at the beginning of this, that the default rate is low, and we're starting to see some improvement in the junk bond market relative to the Treasury bond market, which means that the economy is not in trouble at this moment. Volatility index, we're kind of settling down here, really getting low, which is a very positive sign. High volatility index is pretty much a negative indication. Now, I want to take a minute here and focus on one particular indicator that I think is quite important. This is the aggression index. This is where I'm taking a ratio of the NASDAQ, which is technology stocks primarily, and I'm comparing it to consumer staples. So, I could compare this NASDAQ to the S&P 500, but I'm going with the staples because they are really, when the market starts to get defensive, you're going to see a lot of money flowing into things like Coca-Cola and Procter & Gamble and things like that, very defensive type of industries. Now, we are definitely in a downtrend here on this indicator. This is probably one of the most important warnings I can give you right now. So we're on a sell signal. Let's go back in time and just kind of see how this indicator has worked in the past. This is '07. Now remember, the market itself, the market indexes did not crack and go to the downside till early January. Well, this particular indicator gave a sell signal right back here in November of '07. So in a way, this is somewhat of a leading indicator. Now, as we get into the top five, this is ArcBest, which is a trucking company out of Arkansas. Stock's breaking down, doesn't look positive. Devon Energy, you can see here with the energy stocks breaking out to new highs, very constructive pattern. It looks like energy is going to lead here. Ford Motor Company, what an exciting situation. We do own this stock. We got a major gap up here yesterday on over 300 million shares. Somebody knows something, and what it is, I believe, is that F-150 electric Lightning. The demand is far outstripping. I mean, they're getting tremendous orders here. Stock looks positive. What would be ideal would be to see, after this gap up, somewhat of a consolidation and then a breakout again. Looks positive. On semiconductor, again with the tech stocks down today, barely holding that 10-day moving average. However, of all the tech stocks I'm looking at, this is pretty much one of the healthier patterns. Here's Tesla back on the list. Now, the reason Ford and Tesla are coming back on the list is that earnings estimates are going up for these companies. So with Tesla, you got somewhat of a breakout here in the form of a gap up. However, somewhat failed. This is somewhat of a sloppy base. You can see downtrend. We would call this a V formation. Then we have a downward move here. The pattern's not exactly what I'm looking for, but the stock is definitely showing signs of improvement. So if you have any questions, please give me a call. Thank you very much.